100 right now and 107. Sean speaking first. Some people in the West End prefer to go to the downtown section just because it's such a pain to get.
Numbers drop every year.
Yeah. Yeah.
I think we're just going to end
Right. Yeah. They
I
don't.
think
They
that's
don't
why
do
we're
the
losing
gathering. Yeah. They don't do the gathering thing. Like, yeah. People need a little more frequent of an update. Right.
It's just with the times. I mean, that's what people are doing now.
All right. Good morning, everybody. We're expecting a few more stragglers to come in. I guess the traffic is pretty bad out there. A big shock, by the airport in the morning. But we will get started to make sure we get you out on time. So, welcome to the Financial Reporting and Regulatory Update, or you might refer to it as FRR. That's what that acronym stands for. I'm Adam Boutros. I head up the assurance practice that is based in Oakville, and we cover all of the clients that are set up in the suburbs of Toronto on the west side, so Mississauga, Brampton, Burlington, Oakville, anybody who's sensible enough to not commute downtown on a regular basis. So I think what we prepared for you today, it's a very relevant agenda. You'll see some topics that you may have heard about for the past couple of years around the revenue standard, around the leasing standard. But the big difference is they are becoming a lot more real now. And I've certainly seen it in my client base where clients are preparing detailed project plans, the assessments are getting into looking at contracts, thinking technology impacts, all the things from end to end that you're going to have to deal with in adopting these significant standards. So I would say definitely pay close attention there, speak to the people at your table, compare progress, and definitely reach out to your PwC rep in that regard. A few admin matters. We have breakfast and coffee outside. I think you probably would have had. We'll have a break around 10:15, and then lunch is available right after the session. It'll be quick buffet lunch. Encourage you to stick around and do some networking, and then you can get on with your day. We have an app, the FRR app. So you should have received an email in advance of this session. Pretty easy to download. I would say jump on that. It's going to have all of the content that is being discussed today. It has the attendee list along with the companies, so you can see who else was here. And if you have any troubles downloading the app, you can talk to some people just outside those doors in the back. We also have the slides will be available on pwc.com/ca, and there's a link in the materials that can take you there. Lastly, and importantly for everybody, CPD credits will be emailed out within 2 weeks of the session. So look for that. All right, our presenters. So today we have two people from our National Global Accounting Consulting Services Group. We have Sean Cable and Carolyn Anthony. So Carolyn is, as I said, part of the national and global accounting consulting services team. She works with our global team to develop PwC's position on all of the IFRS developments and standards. So, right in on the ground floor. Works with a number of SEC registrants as well as large Canadian registrants across a number of industries. Sean, similar profile, works with a number of different clients. Also part of the Global Accounting Consulting Services Group, and a member of the CICA Standards Board Task Force on generally accepted auditing standards hierarchy. So there we go. Yeah, a lot of credentials behind both of these two. I work with both of them quite a bit. I think that importantly, they work with audit clients as well as non-audit clients, so they kind of understand the position you're in as you're developing your positions on different accounting matters, and they will be available to you after the session if you have any specific follow-up questions. With that, over to Sean.
Okay. Good morning, everybody. Can everybody hear me at the back? Okay. Now I've got to admit, Carolyn and I have been doing these presentations across the country for a long time, probably longer than I'd like to admit sometimes. And I got to tell you, I'm a little bit nervous about this one, and I'm going to tell you why. After 20 odd years of reading financial statements and prospectuses and all kinds of really fine things, I've had to figure out how to wear reading glasses in the past year, and now I have a new pair. So I'm not really sure how well this is going to go this morning, but we're going to give it a try. So, because the problem is I can either read my notes or I can see the slide clearly. So, bear with me. So what we're going to do this morning is we're going to go through, and if you've been here before, we've got a pretty similar program. We're going to start off with some what we call IFRS in brief, which is kind of a potpourri of some recent developments, some things to be aware of. And then we're going to spend just a little bit of time talking about some of the regulatory concerns that have been expressed around internal controls. Because that's an area that's been getting a lot of regulator attention. We want to focus a little bit on that this morning. And then I've got some comments to make around the new suite of financial instrument standards. We're going to focus primarily on how to assess credit risk and how that ends up affecting your provisions, because that's really the big change for everyone to focus on. And then we've got some highlights on the new revenue standard. A little bit different. Carolyn and I aren't going to alternate back and forth before the break, so you get me all the way through to the break. After the break, Carolyn's going to come up and she's going to do the kind of the heavy lifting, the biggest section of the day, which is the new lease standard, which is kind of our deep dive for today to get into the details of the new lease standard. And then to end the morning before lunch, we've got regulatory developments and other kind of hot topics. So with that, one of the things we wanted to highlight this morning is, besides developing new accounting standards, which the IFRS, or the IASB I should say, has been pretty busy with the past few years, with things like revenue, financial instruments, leasing, insurance. Their other big core activity is around providing interpretations, maintaining the standards, and assisting companies with transition. And they've been doing a lot more from an educational perspective. And we just wanted to briefly highlight that. In Canada, a number of the IASB staff have actually been visiting Canada. Some of you may have participated in some of the sessions that they've done, meetings that they've had with preparers across the country. And as you can see from the quote from the IASB chair, it's really an area of focus. So in terms of the new effective standards, these are the new standards. Nothing really to worry about for 2016 or even 2017 in terms of things that have to be applied in those fiscal years. A couple of narrow scope amendments, which we'll talk about shortly. The real work and the real change comes in 2018 and 2019. So, to touch briefly on a couple of the narrow scope amendments, there's been 3 that have been approved but aren't yet effective. The first one was an amendment to the cash flow statement standard, IAS 7, dealing with more information being disclosed around financing activities. And the genesis of this proposal, and which is now a standard, is really some incremental disclosure around financing activities, which in Europe, a lot of UK companies previously disclosed. And interestingly enough, the way this kind of got started was a bunch of users said, well, we kind of missed this information. We think it would be useful. And the IASB staff said, okay, well, we'll look at it. They added it as a project, and now we have this new standard. So the standard requires disclosures for a number of changes relating to financing or financing liabilities. Disclosures relating to cash flows, changes due to FX rates, changes in fair values, changes resulting from acquisitions and disposals, and then other changes. There's an example in the material of how to do this. They do it by providing a little reconciliation or a roll forward. It's a common way to do it. It is relatively easy, but the roll forward reconciliation isn't actually required. You could do it in other formats. This is effective for fiscal years beginning on or after January 1st, 2017. And in the year of adoption, you only have to provide it for the year of adoption. Obviously, when you get to the second year, you then provide it on a comparative basis. The IASB also made some amendments to provide some additional guidance on the accounting for specific transactions or events relating to share-based payments, where previously IFRS was relatively silent. Those amendments addressed 3 specific areas: the treatment of vesting conditions for cash-settled awards, modifications that change a cash-settled award into an equity award, and the clarification around how to deal with net settlement features for withholding taxes. The withholding tax change, I think, is probably going to be one of the more significant pieces in there, because most of the plans that we see have some ability, if there's taxes that have to be paid by the employee, to do the withholding tax, and it can be a little bit complicated. It's kind of an interesting change from the perspective that the IASB changed the rules to largely align to U.S. GAAP. U.S. GAAP, this was probably one of the more complex areas of share-based payment accounting and income tax accounting. So much so that the FASB is actually in the process of trying to make their accounting simpler, and they've moved away from where the IASB just changed to. Again, this standard is applicable for calendar year companies in 2018. The last one we wanted to highlight was some amendments made to the income tax standard, IAS 12. This one is a fairly limited applicability because it only applies in situations where you have debt securities that are measured at fair value, and the fair value is less than the tax basis. So there was much debate in the IFRS world in terms of how to measure and when to recognize deferred tax assets. So the IASB has provided some clarification around that. Okay, in terms of what's currently on the IFRS work plan. We'll have a couple comments about their more major standards, but in terms of things that they're working on, quite frankly, there's not a lot. There's a couple of narrow scope amendments and an interpretation that should be finalized before the end of the year. The project relating to IAS 40, which is investment properties, deals with how to account for investment properties that have been transferred into or out of the investment property classification. It's obviously important because investment property gets carried at fair value under IAS 40. The Interpretations Committee has addressed an issue where there was divergence in practice around how to account for and which foreign exchange rate should be applied to advances received or paid that you've got as either a advance as a asset or like a deferred revenue item. So it's a non-monetary item. So the question is, do you use a historical rate or do you use a spot rate? So where the IASB has been heading is that you need to use a spot rate even though it's a non-monetary item. So for some companies that have big deferred revenue balances, this may be a significant change. Transition for this, you get a bit of a choice. It can be either prospective or retrospective, or at least that's where they're heading right now. And then finally, last one, which we've talked about in some of our sessions before, deals with IAS 1 and the classification of liabilities. And again, here the issue has been, what do you look at? Do you look at the events and conditions that existed solely at the balance sheet date, or could you have situations where the classification changes based upon events that happen after the balance sheet date? And I'm sure you'll all remember that when we transitioned from old Canadian GAAP to IFRS, that was a big change because IFRS, generally speaking, requires you to determine the classification based on the balance sheet date. And that's largely where this proposal is clarifying as well. So what we normally tell people is if you think you're going to not meet your bank covenants, or you're going to have something which makes liabilities due at the balance sheet date, it's one of those things that you have to try to sort out before year end or before the period end, because they're all non-adjusting subsequent events if you change the classification or change the agreements to try to get a different classification after the balance sheet date. Okay, so in addition to their maintenance project, the IASB has recently been updating its roster of active projects. And the real reason they've been doing that is because they have been coming to the end of the big projects that they've been working on, which have been taking up all of their time. So it's the revenue project, which has been finalized, the leasing project that's been finalized, the financial instruments, which has largely been finalized, and insurance, which is winding down and also expected to be done by the end of the year. They have been working on another couple of projects which are going to have new standards that are applicable before the end of the year. Insurance is the one, and then they've also been working on updating the conceptual framework. Conceptual framework update is even hard to get some of us techie accountants excited about, but it's expected to be updated probably sometime in 2017. In a large part, quite frankly, because the most contentious parts of updating the conceptual framework being things like how to distinguish between liabilities and equity, they largely took out of the current project so that they could finish the update to the conceptual framework on a timely basis. What that really means is they're not done updating the conceptual framework. They also published an exposure draft on a new piece of, I'll say guidance, although I use guidance kind of loosely. The IASB has been again, they've been trying to provide more educational material, more guidance to preparers, and one of the areas that they heard people could use more more assistance with was the application of materiality. So they've prepared what they call a proposed practice statement on materiality. Now, it's largely going through a very similar due process to a standard would go through, but it won't actually be part of the authoritative literature. So it's one of those things where there's a big debate about around, well, it's nice that the IASB put something out, but it's not actually part of GAAP. What do we do with it? Again, largely speaking, we're not expecting the practice statement to really change things very much, but it will be something else out there if you're looking for more guidance in terms of how you make those materiality assessments. And then in terms of the other agenda items, where the IASB right now is they're largely in the discussion paper phase. So before they get into active standard setting, actually writing exposure drafts, they're in the let's put out some discussion papers, explore the issues, and try to see if there's any consensus around the issues. And there's a number of areas that they're working on, kind of holes, so to speak, in the IFRS framework right now. So rate-regulated activities, business combinations under common control, debt versus equity is the second last bullet on the list. And then to address the concerns that are out there around disclosure overload and just too much detail in notes, they're going to do a discussion paper on the principles of disclosure. So something that will, as a standard setter, give them a bit of a framework to help them figure out what disclosures should really be in a standard, as opposed to just providing what often seems like just a huge laundry list of all the disclosures everybody would like. Doing okay, Carolyn?
Need any help or you're good?
No, I'm doing okay so far. And we're on time. I'm glad I don't have the pressure of being done before lunch. Okay, so turning now to internal controls. So it's been a number of years since companies have had to report on the design and operating effectiveness of internal controls. And for those of you in the audience who are involved with companies that file with the SEC, have had to get auditors involved in auditing those management assertions on internal controls. So in both Canada and the U.S. and with quite frankly our auditor regulators, we continue to see a really big focus on internal controls, and it's one of the things that I think we're seeing in both Canada and the U.S. And in other places around the world. Regulators are reminding companies of the importance of internal controls, and it also comes up with the number of new accounting standards that are going to be applied over the next couple of years, which are going to have in some cases, some pretty big implications around controls. Now, this topic isn't here because it's necessarily a bad news story, although that might have to do a little bit with your perspective, because there actually has been some good news around controls. The SEC in particular has noted an increase in the number of companies that have reported material weaknesses, even though they don't have a material misstatement in the financial statements. And the SEC has been of the view that that is a good news story, because their view has been that internal controls over financial reporting should be a leading indicator around the quality of financial reporting. And when companies first started reporting internal controls, they only seemed to, or at least in some cases, they only seemed to report material weaknesses when there was a material misstatement and a restatement in the financial statements. There have been a number of enforcement actions around controls. There have been some instances where companies have had to restate their internal control certifications, even though they didn't have a material misstatement to the financial statements. So really our takeaway message from here for everybody today is that internal controls over financial reporting is getting a lot more scrutiny from everybody in the financial reporting food chain. So be aware, be aware. And then really the second reminder is that we are entering a phase of financial reporting in Canada where we're going to get back into having to deal with a number of new major accounting standards. Revenue and financial instruments will be effective in 18. In 19, we have the new lease standard. And controls, I think it's fair to say, controls will have to change. Leases will be one where, again, recognizing and putting those obligations and assets on the balance sheet are going to need new controls. Okay. So with that, now I'm going to turn to financial instruments and IFRS 9. And I was going back, so getting ready for this, I was going back and I was looking at the past presentations, and I think we've been talking about IFRS 9 since about 2010, 2011. The current version of IFRS 9 was first published in July of 2014, and it essentially completed the IASB project to really update financial instruments and, where possible, converge with US GAAP. Because the financial instruments project was initially intended to be one of those convergence projects with US GAAP. Now, unfortunately, for those of you who have to play in multiple GAAPs or care about US to IFRS GAAP differences, convergence with US GAAP was not achieved on many fronts. There are significant differences in the classification and measurement models, and particularly the impairment model. Now, the FASB is still in the process of addressing their amendments to the hedging rules, so it's possible that even more differences may arise. The final piece that the IASB and the FASB tried to address together and where they diverged was relating to credit losses. And with credit losses, we now have the complete standard. Now, there is one part relating to IFRS 9 that isn't complete, and that deals with macro hedging. And macro hedging is this concept of taking a portfolio of assets to which assets are constantly being added or removed, and how do you hedge that portfolio? And here, the IASB had put out an initial discussion paper, which, to say it wasn't particularly well received is probably a little bit of an understatement. Larissa's smiling. The discussion paper was not well received at all. Actually, so much so that the IASB has essentially gone back to the drawing board and is going to be expected to put out another discussion paper sometime in 2017. I think the notes say the expectation is early 2017. We'll see. The IASB timetable tends to slip. Again, my own personal views, it wouldn't surprise me if this one slips a little. So in terms of the timetable, so where we are is the current version of IFRS 9 is effective and mandatory for fiscal years beginning on or after January the 1st, 2018. And that's the same date as the new revenue standard. Now, you can adopt early. We have seen a number of companies and clients that have adopted over the past number of years. If you had adopted early, you would have had some choices around which version you wanted to adopt. Those choices no longer exist. If you decide to early adopt, you have to adopt the final 2014 version of IFRS 9. The provisions relating to how you deal with the changes in the company's own credit risk when you measure financial liabilities at fair value, they can be adopted early as kind of like a single standalone piece. That's still out there. Because IFRS 9 doesn't include any guidance relating to macro hedging, if you want to adopt early, there's an accounting policy choice to say I can either go to the IFRS 9 amended hedging requirements, or I can keep with the IAS 39 hedging requirements, so the existing hedging requirements. The idea being behind that is they didn't want to have companies have to change to IFRS 9 hedging, and then if they wanted to do macro hedging, change again. So it's a bit of an accommodation. The other accommodation that they're working on is insurers. So companies with insurance activities are also going to be impacted rather significantly by the new financial instrument rules for obvious reasons. And insurers were concerned about that there could be some negative consequences to them of having to transition to the financial instrument rules first and then transition to the new insurance rules later. So after a little bit of debate, the IASB is expected to introduce essentially a deferral for insurance entities so that they can defer it to when the insurance standard is going to be effective. That is also a little bit interesting because depending upon how the wording of that amendment is worded, have to take a look quite carefully at whether or not you're included in the scope of the deferral or not. And just a reminder that in IFRS 9, the general principle on adoption is that it's retrospective, except for hedging, where it's generally applied prospectively. Retrospective is a little bit tricky in that it's not as straightforward as retrospective normally is, where you go back and change all the comparatives, because you can only change the comparatives if you can do so without hindsight. So there may be some instances where you have to look retrospectively from a recognition and measurement perspective, but you don't actually change the prior financial statements. Okay, so in terms of a really quick recap in terms of what IFRS 9 covers, again, it's complete soup to nuts, so to speak, dealing with financial instruments. In prior years, we've gone into more details around the classification and measurement. So the three categories that we have today, held to maturity, loans and receivables, and available for sale, are now replaced with three new categories: amortized cost, fair value through P&L, and fair value through OCI. Rather than largely being a designation type model or a default model, unless you fall into having certain bad behavior, like having held to maturity and selling early where you no longer qualify. Classification is now based on the business model that's used to manage the asset and the nature of the contractual cash flow. So amortized cost for simple debt securities that are essentially being held to maturity to earn interest. And we get this new term where the contractual cash flows are solely payments of principal and interest. So the term you'll hear thrown around is SPPI, solely payments of principal and interest. Then you've got fair value through OCI, which again is typically speaking going to be for your simple debt instruments. You're holding it to earn interest, but you may sell it at some point during the the term. They go through OCI. And then everything else is in your third category, which is fair value through P&L. Talked about this last year. One of the big changes that's going to impact you is if you have an investment in convertible debt, under existing GAAP, you had to bifurcate out the conversion feature, and you'd account for it as a debt instrument, and then you'd have the derivative for the conversion feature. The way this works, to give you an example of, that would be an example of an instrument that fails the SPPI test because of the conversion feature. It's not solely payments of principal and interest. So you don't have to worry about bifurcating that instrument anymore. You just end up accounting for it at fair value. So in terms of impairment, the issue around impairment was that we had an incurred loss model. So when the financial crisis in 2008 and 2010 occurred, again, give you an example of how fast accounting standards setters can react to these sometimes, there was concern that impairment losses weren't being recognized on financial assets soon enough. So the whole genesis behind the amendments to the impairment model was to move from an incurred loss model to an expected loss model, with the idea that losses would be recognized sooner. And the view, whether you agree with it or not, is that recognizing credit losses sooner will be better for financial markets. It'll give users better financial information, and to the extent that accounting is important in life, it will give better accounting results. And then finally on hedging, the criteria for applying hedge accounting has generally been, describe it as kind of being overhauled to align more closely with risk management activities. So there may be a number of things that you couldn't apply hedge accounting for under the old standard that you can under the new standard. And we have seen some companies and clients that have adopted the new hedging rules early for this particular reason. The classic example that we like to use, the best way I can think to explain it, is under the old rules, it wasn't possible to hedge, say, the price of rubber if you were manufacturing tires. Now, generally speaking, if that's your risk management objective, you can. The mechanics largely stay the same. We still have fair value hedges. We still have cash flow hedges. You still have foreign exchange hedges. You still have to measure ineffectiveness through the P&L. So that is the quick recap on IFRS 9. Now, in terms of the general impairment model, so like I said, the new model is what they call an expected credit loss model. And I'm going to give you an example to help kind of crystallize what this really means in a minute. And the way the model works is you're required to recognize a portion for credit losses at the first financial reporting date after initial recognition. So lots of people will come up and say, well, isn't this kind of like recognizing a day one loss, even for something that's very highly rated and has a very low risk of having any credit risk attached to it? And the answer to that is yes, and it is somewhat counterintuitive. That I could enter into a loan with, let's say, a 1% default risk of default. I enter into it at day one. I recognize it at fair value, but then on day two, I have to put a provision against it, even though I have a very low discount rate or a very low credit risk. That's unfortunately the way the model works, and it's entirely to address this issue that too little was being recognized too late. Now, the way the model works is it has this concept of having 3 different stages, which is our stoplight on the slide. So stage 1 is where you have a financial asset, it's performing, hasn't deteriorated significantly in credit quality since inception, but you still have to recognize a provision, and the provision that you recognize is based on the 12-month expected losses, which is the portion of the lifetime expected losses based on the risk of default in the next 12 months. And we'll show you what that means on the next slide. Stage 2 kicks in where you have an underperforming asset, which is the concept that there's been a significant increase in credit risk than when it was originated, but there's still no objective evidence of impairment. And in that scenario, you end up recognizing what's called the expected credit losses over the lifetime. And again, clarify this in an example in just a second. And then the third stage is where things are really bad. So that's where you have your non-performing financial asset and you've got an objective level of impairment. Now, one of the things that makes this model particularly complicated is that the credit quality can move over the lifetime of an asset. So you can move between categories. So, like a lot of things in accounting, whenever you move between categories, you need rules for how you handle moving things between categories. You also need controls to monitor for moving things between categories. Then lastly, if there's no reasonable expectation that you're going to recover, that's the equivalent of, in Monopoly, go to jail, don't collect $200, you write it off. Okay, so the example, let me try this with a little bit of an example. So let's say you loan somebody a bunch of money, and if they don't pay and you go into default, once you expect, you might expect that you can collect collateral, whatever it is, you expect that you would still have $1 million loss, just to keep the numbers nice and round. So the concept here is that if the probability of default in the next 12 months was, let's just say 1%, it's pretty low. When you're in phase 1 and you have to recognize the next 12 months expected credit loss, you take your 1% chance of default, multiply it by the $1 million you'd lose if they default, and that becomes your provision. When you move to phase 2, your lifetime expected credit loss, again, your credit loss is still the same because it's not usually not impacted by whether or not when the default occurs. You then take what the probability of default is over the expected life. So if it was say a 10-year receivable, and you thought there was a 5% chance that there might be a default over the life of the instrument, then your provision becomes 5% multiplied by your $1 million loss. Does that make sense to everybody? Pardon?
I get it.
Carolyn gets it. That's a good sign. And Like I said off the top, I think I've been doing this for almost 20 years now, and usually when we got more than about 50 people in a room, no one really wants to ask a question during the session. So that's okay. Carolyn and I will be here at the break and after lunch, so feel free to come up. So as you can probably imagine, depending upon how significant the loss is and how significant the differences in probability of default are, this changes between categories or changes over the life may cause your provision to move around a fair bit. Now, that being said, if you've got short-term receivables, very low risk of default, again, what you may find is that when you do the expected loss model, that the numbers are actually very similar to what you have on your books today as your provision. And in a few of the companies that we've seen that have adopted this, they haven't really been the financial instruments folks, the guys that have a lot of financial assets on their books where this may be more material. The effect of the adoption has been relatively small. Okay. Now, there are, and the IASB tried to help everybody out by putting in some simplifications around the model, particularly dealing with tracking the movements between stage 1 and stage 2 because there was a lot of concern around that. So what they did was for trade receivables and contract assets that are recognized under IFRS 15 that do not have a significant financing component and have a maturity of 1 year or less, then in those cases you can just measure using lifetime credit losses. So that is a rather significant accommodation from a controls and processes perspective, because you don't have to worry about trying to differentiate between what's my risk of loss in the next 12 months versus what's my risk of loss over the lifetime of the instrument. And I don't have to worry about tracking it. Again, maybe a little bit more volatile because in a lot of cases you'll end up setting up those provisions but then reversing them. For lease receivables and trade receivables with a significant financing component, there's a policy choice to either use the simplified approach or the general approach. That's a policy election that you can make independently for each type of financial asset. You have to think about whether or not there's a significant financing component based upon the guidance that exists in the revenue standard. And you need to think about whether or not the model is suitable for your business circumstances. So this is kind of our example that kind of puts together what's called a provisional matrix. So in terms of applying the practical expedient, this is the example of the practical expedient from the standard, and the concept is that it's a provision matrix. So you segment by your customers, you look at your historical discount rates. Depending upon where you are, you may need to stratify based on geography. So, if you sell to customers all across Canada, credit risk may be different in places like Alberta right now than compared to Ontario. You need to track it, you need to update it, and then go from there. So that brings me to the end of financial instruments. Again, the credit risk impairment model is where we expect probably the more significant changes and the most amount of work for everyone is going to be around adopting IFRS 9. We didn't get into it today, but there are, like most new standards, a number of new disclosures, which will also take more time to prepare than the existing disclosures. So keep that in mind. And thinking ahead to next year, I suspect disclosure might be on our list of things to talk about. Okay. So let me turn to revenue now. So the revenue standard, the name of the revenue standard is revenue from contracts with customers, which doesn't really shorten down very well. It was also issued in 2014, and at the time, notes that we prepared say it was virtually identical to U.S. GAAP. I think at the time it was issued, I think there was either 5 or 6 identifiable known GAAP differences at the time, so not very much. Over the past couple of years, the standard, companies have been starting to apply it. We've all been thinking about it. The IASB and the FASB, we talked about this last year, organized what they called a transitional resource group to meet on a quarterly basis globally to talk about the implementation of the standard and what the issues are. They've looked at an awful lot of issues. I think the number that they've looked at is in the neighborhood of about 130, give or take. There was only about 5 issues, though, out of all of those, where there was much divergence of views, and they directed the topics back to the IASB and the FASB respectively to consider whether the standard should be amended or clarified, and I'll talk about those 5 in a minute. One of the interesting things that's happened with the TRG is that initially the TRG started off as this joint project between the FASB and the IASB. And the IASB in January of this year kind of left the TRG but didn't really leave the TRG. And what I mean by that was they said, well, we're still going to send our staff to the meetings and we'll still listen, but we're not going to send any of the international TRG members to the meetings, and we're not going to consider any more amendments unless something really, really big comes up. And the reason why they did that was the international board was of the view that the standard was done, it was close enough, there were no more big issues, and what preparers really needed was a steady state of not having any more changes. That's not the approach that the FASB has taken. The FASB has continued to meet, continued to debate, and continued to make some amendments. So the number of differences between the international version and the US version is growing. If all of the amendments that are in process right now get approved by the FASB, our list originally is probably going to be getting close to doubling. Okay, so before we get into kind of the issues and then some of the challenges that we've been seeing around IFRS 15, just quickly highlight the timetable again. So IFRS 15 is effective for fiscal years beginning on January the 1st, 2018, so just over a year. If you're interested, I did the math this morning. I was here a little bit early. I tried to beat the traffic. That's 479 days from now. 478, because we won't count today. IFRS 9 is also effective at the same date. And I don't want to steal any of Carolyn's thunder, but if you want, you can adopt IFRS 16 dealing with leases early as well. And I'm aware of at least one client that's thinking about it, mostly because they're going to have a particular accounting issue under the revenue standard, which might go away if they adopt the lease standard early. So again, that's just kind of something I'm trying to make this a little interesting this morning. So, but again, we're not really expecting most people to adopt all three standards at the same time. You can adopt IFRS 15 early. There are a few. The vast majority of the ones that I've seen, I think I've seen 5 or 6. I think 5 of them were essentially startup companies that had no revenue with customers yet. But you can, no one's really done it. One thing to keep in mind is that with transition, there is a policy choice to make around how you transition. You can either transition on what's called a full retrospective basis, where you restate prior periods, or you can adopt on a modified retrospective basis, where you don't restate prior comparatives, but you have to provide some incremental disclosure in the year of transition for comparability. That sounds like an exciting choice to make. One thing to keep in mind in making that choice, if you're a public company or you're thinking about becoming a public company and you are active in the prospectus market, one of the things to think about around adopting on a full retrospective basis is that if you go full retrospective and you file a prospectus after you have adopted in Q1 of 2018, but you haven't restated your comparatives yet, you'll have to restate or provide comparative information for IFRS 15 for your last annual, which will be 16 and 17. Because under the rules, you got to get all of the periods in a prospectus comparative somehow. If you're going to have big changes on adoption to IFRS 15, that may be something to think about in terms of your strategy around your method of transition. Okay. We're doing okay for time, aren't we? We're doing okay for time. We're doing okay for time. Yeah, in case you don't know, I mentioned this to a couple people this morning. And if you've been coming to this one regular, you may have figured this out by now. But this session is like the most important one of all the ones that we do across Toronto, all across the country, not just Toronto, because it's our first one. So we've practiced, we've coordinated, but until we actually do it the first time and see how it goes, it's really important to get the feedback of how this goes. So that's why this is like the most important session. So in terms of the amendments, the TRG members, they had differences of views around 5 topics: identifying performance obligations, principal versus agent considerations, how to deal with licenses and licensing agreements, the guidance as it was written around collectability, and the measurement of non-cash consideration. So the IASB decided to make amendments or clarifications to the standard for the first 3, which are 1, 2, and 3 on the slide. And they placed a very high hurdle on the amendments. They were only, when you look at the debate, if you listen to the debate, it's very clear that they were only trying to amend it where it was essential to clarify the board's intentions and where the cost of making the amendment was outweighed, or the benefits outweighed the costs. They didn't make amendments around collectability and measuring non-cash because they thought that if you looked at what was in IFRS 15 and what was in the basis of conclusion, that what they said was sufficient. So it's one of these things where, personally, what I would say is I've got a lot of sympathy for the difference of views that existed around something like non-cash consideration or even collectability. But given where and what the board has said, even though board meetings aren't authoritative, I think everybody's expectation is, because they debated the amendment and decided not to make the amendment because they thought it was clear, that was effectively their way of shutting down that viewpoint. So we'll talk about each of these in a little bit more detail. The first issue deals with how you determine performance obligations. And again, we've talked about this in the past. Performance obligations are largely similar to what we would call a deliverable under existing IFRS. And under IFRS, in order to account for a performance obligation under the standard separately from other performance obligations, it must be, the new word in the standard is distinct, and that's kind of similar to the notion that used to be behind the notion of existing GAAP of that it's distinct if it has standalone value to the customer. In order to be distinct, it must also be separately identifiable. The separately identifiable part was the new part, and the issue that was raised when the TRG started debating this, and I should say all of the TRG issues essentially came from companies that were starting to apply the standard and were having trouble, and that's what led to all of the TRG issues. So the issue was that this concept of separately identifiable may be applied more broadly than the standard setters really intended. So if you think about it, and the best examples I can think of are, I'll give you two. One is, so you get a phone, you get a cell phone, a BlackBerry, no one gets BlackBerries anymore, but you get an iPhone, you get a phone, and then you get a data and you get a cell plan. Or you go and you buy a photocopier, but with the photocopier, you get an agreement to supply paper and toner. So the question was, are those things separately identifiable? Because there were some people who were arguing really, really passionately, the telecoms being one, that, well, if I have a customer with a cell phone, and it's a smartphone, and they got a data plan, those really aren't separable, notwithstanding that they're distinct. And that has a really big implication on the timing of revenue recognition in some cases when you get in the subsequent phases, because if my cell phone and my data plan are distinct and separately identifiable, then I have to recognize the cell phone when control passes to the customer, and then the data gets recognized all along. And that's a big difference from the way telcos do things today. Again, this comes up in a number of other areas. It comes up in healthcare. Which is, again, very similar, in a lot of cases, very similar to the photocopier and the paper. It's just medical equipment and the supplies. It comes up in contracting. Actually, I'm going to give away another slide, so I'm going to stop with that for a second. So how did the IASB resolve this? Well, in their amendments, they clarified the principle for separating, as well as the factors that you would apply to indicate that two or more promises are either not separable or separable. And they added some examples around particularly the bundling, to make it clear that when you apply the factors that they gave you, and I'll tell you what the factors are in a second, that your smartphone is separable from the data, because even though you use the two together, it's a separate output, and the output doesn't transform the other. And that's the concept that they put into the standard. So if I go back to my photocopier and paper example, yes, you use them together. The consumables, the paper, has a functional relationship to the equipment, but it doesn't transform the equipment, so that makes them separable. Now that's different than if I've got a build design contract for, say, a hospital, where the whole thing is integrated and all of the inputs are interrelated and integrated and necessary to build the final product. So the factors that they came up with are things like the degree of customization, the complexity of the arrangement, the customer's motivation for purchasing the items. They like that one with the cell phone example, because they say no one really purchases the cell phone just to have a handset. It's what you do with the handset that matters. Contractual restrictions that exist in the contract, and then the functionality of the individual items. So identifying performance obligations under the new standard can be a little bit tricky. It's definitely one of those areas where I think there's a fair amount of judgment. Okay. So the next area where the IASB agreed to make some changes was around principal versus agent considerations, or gross versus net. So the concept here is that, and actually I should take a step back. So under the new standard, as we've talked about before, you used to recognize revenue before on a risks, when risks and rewards had transferred, all that good stuff. It's now based on a control model. Control is similar and includes risks and rewards, but the control point and the risks and rewards point may not be the same. When people started to think about principal versus agent, or that gross versus net questions, what they were struggling with was that when they wrote the standard, they largely took the guidance that existed in US GAAP, which was written to think about principal versus agent or gross versus net from a risks and rewards perspective, and put it into the standard, which then recognized revenue based on control transferring. So it didn't mesh well. And that was causing people a lot of concern, because they were struggling with, how do I apply the control model when the criteria that I've got for thinking about principal versus agent is all based on risks and rewards. So how was this issue resolved? Well, it didn't actually take the IASB and the FASB very long to acknowledge that, yeah, well, we kind of goofed on this one. And what they did was they took the guidance that was in the standard and rewrote it and kind of tweaked it and tried to change some of the factors to make it clear that when you're thinking about the risks and rewards in terms of who's the principal or who's the agent, you're trying to think about who controls what's being transferred before. And you can only be the principal if you control the good or service before it's being transferred. So if you're the agent, then you don't really control it, or you can't control it, because you're just the agent. So this comes up, this comes up in a number of scenarios, film distribution, research arrangements, software, auction houses. So this is one of these ones, in fairness, where in a lot of cases, the people who are agents under existing GAAP don't have control, but that's not always the case. And vice versa, there may be some principals out there where they either have control or don't have control, but they were doing it on a gross basis because they had the predominance when you weighted the factors. So if you're in that bucket where you have a lot of transactions on a gross, where you've had to think about gross versus net in the past, take a look at the new guidance and think about a little bit about control, because you can get a different answer. Okay, so licenses, we've talked about licenses for the past couple of years. This has clearly been an area that has been a challenging topic for the standard setters. It was one of the last areas of the standard to get finalized. They spent a lot of time talking about it when they were developing the standard. And there were a couple of issues as people started to apply the standard and think about how it should be applied that came up. And one was around how the nature of the license affects revenue recognition, and the other was how to apply the royalty exception. And this is one where, at least personally, I think it's unfortunate that the IASB and the FASB didn't get more closely aligned, because they have essentially completely diverged in terms of where they're heading around this standard and the amendments that they're proposing. So the IASB tried to clarify their guidance and provide a bunch of illustrative examples in terms of determining whether a license is a right to access throughout the license period, or it's a right to use the license as it exists at the date it is granted. And that is an important distinction, because if it's a right to access during the license period, revenue gets recognized over the license period, whereas if it's a right to use the IP at the point in time and going forward, you recognize revenue at the point of time that control passes. So generally, we're expecting a lot of times today, right now, licenses are, and the income is recognized over the licensing period. Our expectation is that a number of those arrangements, revenue will have to be recognized sooner. The other issue that comes up was around royalties, and the issue around royalties is that there is, I should say, in the standard, a cap on the amount. There's an exception in the standard that limits revenue recognition where you've got sales-based royalties. And there's been questions about whether or not you fit into that exemption or not. And it only applies where the sole or the predominant item to which the royalty relates is a license. So the best example I can think of this is, think about a pharmaceutical R&D company. They license some intellectual property to somebody, but they say at the same time, we will give you some, or we'll include in this arrangement some small batches of the compound, allow you to do your testing, develop it, whatever you're going to do with it. So the question was, well, can I apply the royalty exception to that? arrangement, because it's not just the IP that's being done. I've also got this small inventory that's in there. So there were some people out there that were saying, well, can't apply the exception in that case because it's not the sole or predominant item. And what they've tried to clarify is that in that case, because in my example, because the inventory is relatively small, the license does predominantly relate to the royalty, or the royalty does predominantly relate to the license, you can still apply the exemption. So those are the types of arrangements that have been causing people some grief when they think about the standard. Okay. So in terms of some other challenges, that we've been seeing around the standard, this is our attempt to try to highlight some things out by industry and what some of the bigger issues have been. There's a lot of interpretation guidance and guidance out there, particularly in the U.S. In the U.S., the AICPA industry groups have been working, and they're starting to publish a lot more position papers. So we're starting to get a much bigger sense of at least where the Americans are heading on some of these things. So, depending on what industry you're in, some issues are bigger than others. So, in the utility space, there's still a big debate about, if I get a payment from a customer to assist for hardware that I have to install for them to be able to, say, use my electricity, if I'm an electricity producer, how do I count for that under the standard? Take-or-pay arrangements in energy. Lots and lots of issues in telecom, although I think at least the big telecom players, if you look at what's in their statements, they're all pretty well advanced. Although it's interesting, they've said some interesting things, like from a systems perspective, they've said from a telecom perspective, they expect to spend more on the systems related to IFRS 15 than they spent applying SOX, which is a lot. Again, some of the customer incentives, contract costs are different. So if you're in an industry that has a lot of contract costs, asset managers, performance fees in asset manager space, significant financing components in say, real estate arrangements, comes up in other industries as well. Collectability. So collectability, the reason why collectability is important, and I'll give you an example of this. So let's say I'm selling real estate, and in order to get into IFRS 15 and recognize revenue, you have to have a contract with a customer. In order to have a contract with a customer, it must be probable that you're going to collect. If it's not probable that you're going to collect, you don't get any revenue recognition, even if you get cash. Now, you may eventually get to recognize that cash as income when there's no remaining performance obligations, it's not refundable, and the contract has been terminated. But until then, you end up with deferred revenue. So big issue particularly in real estate. If you don't get over that probable of collection, you can't do revenue recognition on like a cash basis, which is where there are some other industries out there where revenue was recognized on a cash basis. And that, unfortunately, is one of the differences with US GAAP, is that the probability threshold is different between IFRS and US GAAP. So you might have a contract for IFRS purposes that's within the scope of the revenue guidance, which is not within scope of the revenue recognition guidance under US GAAP. Identifying performance obligations, talked a little bit about that. That's an issue in a number of other scenarios. Anytime there's something thrown into a revenue transaction which is quote unquote free, so free shipping is a problem, free maintenance, loyalty awards, there can be some issues there. There's also issues where you're collecting fees upfront, so like setup fees, connection charges, mobilization charges, membership fees that are paid upfront, initiation fees. Lots of issues there in terms of whether or not those are really separate and distinct performance obligations. The other one that we've been spending a lot of time thinking about is customer options. This can be a particularly complex area, and the debate around options and why this is important is that a customer option can either be what's called a material right under the standard, which has to be treated as a separate performance obligation, or it can just be a marketing offer. And if it's a marketing offer, then you don't have to worry about it from an accounting perspective. If it's a material right and it becomes a separate performance obligation, then you end up, the long story short on this one is you end up having to allocate some of that initial consideration to the material right, and that ends up getting deferred. Particularly big issue in, for example, the one that comes to mind is airlines, where you not only may have points, but you may have award levels, ability to check bags, get into the lounge, those type of things. Variable consideration, that's another area where there's a lot of variable consideration in lots and lots of industries. Mining and oil and gas, you get provisional pricing. Technology and telecom and other industries, you can get volume discounts, rebates, refunds, credits, price concessions. Volume discounts come in a fair bit. Indexed pricing, performance bonuses. Retail and consumer, price protection, price matching, vendor allowances, co-op advertising, asset management, lots of issues there around fees that are based on assets that are under management or the returns on those investments. And the issue there, the short story there is that even if the amount is uncertain, you may have to recognize some of this earlier than we do under existing GAAP today. And the reason why you have to do that is that there is an exception around sales and usage royalties, which I talked a little about earlier, but those exceptions only apply around licenses for intellectual property. So a lot of this variable consideration has nothing to do with intellectual property. So you don't get the exemption, and the concept in the standard is that you will recognize this variable consideration to the extent that it's highly probable that there won't be a significant reversal. And in lots of cases, it may be highly probable that some portion of the variable consideration may be subject to reversal, but there's a certain amount of it that is not highly probable of significant reversal. So you have to be able to estimate that and record it in advance. And the way that works is, and again, this isn't a policy choice, you have to use the method which best predicts. And this is where some of the controls are going to come in, because you're going to need history and you're going to be able to need to monitor this. But you're looking at either doing it based on an expected value calculation or a most likely amount. Okay, we talked about the constraint. Incentives. I only have a few more slides. Incentives. Really quickly, just a couple of more highlights. IFRS doesn't prescribe or prohibit a particular method for estimating standalone selling price, which is what you normally use to allocate consideration between multiple performance obligations. But that being said, you have to look at current selling prices and other data in order to make the best estimate that you can. And in some cases, figuring out what a standalone selling price is can be challenging, particularly in bundles. And there's some special rules in terms of how you go about allocating out bundles. And there's some pretty good examples in some of the IDG material. Can actually give you some, at least what I found to be somewhat counterintuitive answers. If you're recognizing over time, the challenge here is that you have to figure out a method of allocating the revenue over time and measuring that. How you do that, again, is not it's not a free choice. You have to use a method consistent with similar facts and circumstances in all your transactions. It may be an output measure or it may be an input measure, but you have to be careful because the output measure and the input measure may not coincide with when control transfers. And so, for instance, if you might have a bunch of costs that you incur up front, but control doesn't pass till a little bit later in the process. In that case, your input measure may not give you a very reliable estimate of progress because you've got a high level of upfront costs. So, just a little bit over a year to go in terms of until IFRS 15 is applicable. The good news on IFRS 15 is that the IASB should largely be done considering their issues. I think it's fair to say that there's still a fair amount of work for a number of companies in Canada to adopt the standard. Even if there's going to be no accounting changes because you get to the same answer that you have under existing GAAP, the path through the accounting literature is going to be different because the standard doesn't align. So at the very least, you need to think about, do I have the right internal control documentation? Do I have the right analysis? Do my accounting policies say the right things? Disclosures, again, more of a prelude for next year where I suspect we'll get into more of the disclosures. There is a lot more disclosure in the standard being required. And last but not least, again, if you have any questions about IFRS 15 or anything else that we're going to talk about today, we're here today. Anyone from PwC is always available to help. So with that, we're pretty much right at 10 o'clock. We're going to take a break. What I'm going to do is I'm going to say we're going to take a break for 25 minutes with the idea that we're starting at 10:30. So please don't think of it as a 30-minute break because then we won't start till 10:40, but we will start again at 10:30.